Value Investors Club, I'm your host, Timo Wunderlich. Let's get right into it with VIC Readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have LITHIA Motors Inc. LITHIA Motors Inc. CLA. Ticker is LAD. Present point of findings is $227. This is not a recommendation, not advice. Please do your own diligence before investing into anything, and let's get right into it. And please write down in the comments below if you have invested, will invest, or why not into LITHIA Motors Inc., especially after reading this write-up. A description. Note, net debt of 4,008 million is gross debt minus cash and floor plan financing related debt. Thesis. LITHIA Motors Inc. LID stock offers a compelling investment opportunity. At $227 per share, it trades at a depressed 5x 2022 E consensus EPS, 6.3x 2023 E consensus EPS, and 3.8x to 4.5x management's 2025 EPS target of $50 to $60. The valuation is low because the market does not believe that current earnings are sustainable and that management can deliver on its 2025 targets. Although there is uncertainty around 2023 earnings, I believe management's targets are a realistic indication of the company's earnings power 2 to 3 years out. Once we get through 2023, the stock's multiple is likely to revert to its historical median of 12.5x forward earnings, yielding a $625 to $750 share price in 2 years. I think the downside is low, considering the historical low multiple and the skepticism around near-term results, which are to a large extent discounted in the stock price. Description. LITHIA Motors Inc. was founded in 1946 and was listed in 1996. It is the leader in the highly fragmented but rapidly consolidating U.S. automobile retail market. It generates $28 billion in revenue and has an estimated 1.5% market share of the roughly $2 trillion annual U.S. retail market for new and used cars, and including aftermarket services and financing. Consolidation opportunity. There are approximately 17,000 auto dealerships in the US. LITHIA is the largest player with 300 dealerships. Under the leadership of CEO Brian DeBoer since 2012, the company has pursued a methodical consolidation strategy, which has resulted in an EPS CAGR of 32% over the past decade and a 25% return on acquisitions. The top 10 players control about 8% of the industry. LITHIA operates across all segments of the industry. It has new car franchises with 30 OEM brands. It sells used cars, 75% of which are sourced through trade-ins. It finances about 10% of vehicles internally through its captive finance company, DFC. It generates 4% of revenues from online sales through its nationwide e-commerce brand, Driveway. New car sales generate 43% of gross profit. Used cars sales generate 27% of gross profit. Services and parts generate 29% of gross profit. The captive finance subsidiary, DFC, and the e-commerce national brand Driveway are in a ramp-up phase and do not contribute to earnings. Unlike a typical consolidation place where early success attracts capital and drives up acquisition multiples, the auto sector benefits from inherent barriers to entry. OEM agreements and franchise laws for new car dealerships dictate that transactions must be approved by the OEM. OEMs are more concerned with the buyer's ability to execute and provide a good service than with a transaction multiple that will accrue to the seller. LITHIA's management is highly regarded by the OEMs. This has meant a rich pipeline for transactions at reasonable multiples for LITHIA, and a historical average ROIC on acquisitions of 25%. That's great. OEMs recognize that subscale players will not be able to compete long term, and this plays to LITHIA's hand. For example, LITHIA's consolidated SGA/gross profit was 60% in the third quarter of 2022. However, less productive stores have an 80% SGA to gross profit ratio, and large productive stores are closer to 50%. LITHIA often acquires stores with a 90% SGA to gross profit ratio and improves performance through consolidation of back office functions. LITHIA's management approach to consolidation is very methodical. Of the roughly 17,000 dealerships in the US, Lithia has already identified the ones that are desirable for its strategy, roughly 2,700 dealerships. Management has established relationships with the owners and waits for them to be ready to sell. This approach generates a robust pipeline of growth opportunities. In 2021, Lithia acquired 3.5 billion in revenues. In 2021, it acquired 6.9 billion in revenue, and in 2022, it acquired between 2 and 4 billion in revenue. Final numbers have not been disclosed. Management's goal is to reach 50 billion of revenue in 2025, approximately a 2.5% market share, and to eventually reach a 5% market share. Management's goal is to have dealerships within 100 miles of 95% of the US population. Why does the opportunity exist? Skepticism about near term earnings and skepticism about the sustainable base of earnings. The company's earnings went from $11.60 per share in 2022 to $37 per share in 2021, and likely $45 per share in 2022. It's crazy growth. Part of this growth was driven by COVID driven supply chain issues. A shortage of new vehicles resulted in used vehicle price appreciation and an unsustainable step up in industry wide gross profit per unit. This trend is now unwinding rapidly as used car prices drop. The uncertainty about the company's ability to navigate the adjustment in 2023 is being exacerbated by management's staunch unwillingness to provide short-term guidance. This is evident in the Q&A section of the 3Q 2022 result conference call. I do not have a strong view on 2023 earnings, but I am confident that we are not going back to 2020 numbers for several reasons. At the beginning of 2020, Lithia had 180 locations. At the beginning of 2023, Lithia had 300 locations. Two initiatives, DFC, Captive Finance Sud, and Driveway, online national brand, were loss-making in 2020 and approaching break-even in 2022. There's a lot of operating leverage from SGA, and there are ample synergies between the online business and the physical stores. Management believes that over time, the SGA slash gross profit ratio will trend from the current 60 to 50%. This trend is apparent in results. The finance subsidiary has scaled and reached break even, but only represents 10% of vehicles financed. Management's goal to reach 25% in 2 years will be highly margin accretive. The pipeline of acquisitions continues to grow, and the prospective ROIC seems attractive as per management guidance. Fears of disruption. There are several sources of disruption which this company is likely to face in the coming decades. E-commerce is just beginning to ramp in this industry, and investors fear that, like in other verticals, physical stores will become a drag on profitability. Electric vehicle penetration will continue to grow, and they have less moving parts than internal combustion engines powered vehicles. For example, they do not require an oil change. Investors fear that this will be a drag on parts and services, which accounts for one third of Lithia's gross profit. Cars are highly underutilized, and we are eventually going to move towards driverless cars. This will challenge the idea of car ownerships as we know it. We will move to a mobility as a service MaaS model, and traditional OEMs and their dealerships will be completely disrupted. The market will be controlled by Apple, Google, and Tesla. Here are a few counter arguments. Disruption will come, but it will take longer than expected. Today, the age of the average car is 12 years. The average used car sold by Lithia is 9 years. The economic reality is such that the average buyer has a negative equity of $5,000. This needs to be covered by financing. The barrier to people buying new cars is mostly economic. The move toward electric and driverless will be gradual. There are legal, bureaucratic, and infrastructure barriers, which will delay the full adoption of driverless vehicles for a couple of decades. Lithia is in a better position than 90% of the industry to adapt and adjust to these changes. Management has proven to be at adjusting in the past and is well aware of these threats. Management owns a lot of stock and thinks like an owner. Lithia is in a much better position to benefit from the move to e-commerce than the pure play companies like Havana. The biggest challenges to selling cars online are sourcing used cars and managing the logistics of refurbishment, storage, and delivery. LITHIA has the same gross margin but much low costs of storage, logistics, and delivery. It can leverage its existing employees, 200 refurbishment slash storage centers, and it will soon have locations within 100 miles of 95% of the population, giving it an edge over the pure play e-commerce players in terms of delivery costs. Furthermore, Lithia has a much easier time sourcing inventory of used cars than the pure plays. The following presentation is from Lithia's 3Q 2022 results presentation. Oh, it's a comparison between Lithia, Carvana, CarMax, and traditional new franchise retailers. Lithia is the second place in revenue after CarMax, and they claim to address full consumer life cycle, which only traditional new franchise retailers do as well. The CarMax and Carvana do not. Yeah, the rest you can see of yourself. Conclusion: Lithia Motors Inc. (LID) stock is undervalued due to concerns over short-term earnings and long-term disruption. The company is a cyclical growth company that has grown EPS at a 32% CAGR over the past 10 years while maintaining a 20% plus ROE. Management is capable and has significant ownership in the company. The industry is highly fragmented, and Lithia is in a unique position to grow profitability through acquisitions for the foreseeable future. Risks: disruption comes faster than expected from driverless cars. Management fails to continue to execute and adapt. 2023 is much worse than expected in terms of volumes and margins. Catalyst: as 2023 progresses, the company's sustainable earnings power becomes evident. Thank you very much for tuning in, and see you